Is this a tradable bounce we're seeing today? Would you be putting money back into work right now? Buy the dips worked really well recently.
Only as a scalper. Only as a very short-term trader, hour by hour. Not as an investor looking out a few weeks and a few months or even 2 or 3 years.
Why not?
Because I think this is the beginning of a structural bear market that will take the shape that is very different from 2008. 2008 was a one-year waterfall decline. This is going to be a managed bear market by the authorities because the upside is very limited. And the downside, they have to limit. So whenever the market sells off, let's say 20, 25% or so, they come in to support it. And then the market can rally again, and then it fades again, and it goes down, and it goes deeper than last time. So I think this is pretty serious, very difficult market ahead. For traders, it's great. For investors and buy and hold index buyers, it's very bad news.
So what is interesting here is that in some ways we should have seen this coming. China's been down hard. Asia's been down hard. Let me show you this chart here. The gap between Europe and the United States in dollars in terms of the markets we have on either side of the Atlantic. We are looking at a situation where the rest of the world has been here for a while. It's just the US markets that are now catching up.
That's right, yeah. The US market was really attracting tremendous money inflow from all over the world with a stronger dollar, with a reflated economy due to the fiscal stimulus. And therefore, everybody believed the US was the place to be. And it was for a while. And now the US is catching up because the tightening that is going on in monetary policy in the US first affected the weak elements, the weakest at the periphery of the EM universe, Argentina, Brazil, South Africa, Turkey, etc. And now it's working towards the center. So it's now beginning to affect the US. This is just the first shot down. It's not over, it's the beginning.
Hi, Felix. Bonnie in New York. Felix, why now? Economic fundamentals in the US are pretty strong. Earnings are supposed to come in very strong this quarter again. So what's the catalyst?
Earnings always look great at the top, you know, and earnings look weak at the bottom. So you cannot use earnings to develop a investment strategy. The problem here is really monetary policy. The tightening that is going on by the Fed means they are taking out $50 billion of liquidity every month. On an annual basis, that's $600 billion they take out. And the Fed is not just a central bank to the US. The Fed is the central bank to the global monetary system. And you have to understand that this tightening is affecting the whole world. So you have now an economy, a world economy, that is slowing everywhere outside of the US. China is slowing and is taking down the EM universe. It's taking down Europe as well. And nobody seems to be concerned because it's coming from a relatively high level of activity. But that will lead to a wake-up because the slowdown continues and therefore earnings will be cut. There are leading indicators for earnings, and the leading indicators for earnings all point down on a global basis. And that will come, and as they cut estimates, prices will not rally, but prices of stocks will fall.